Invest smarter, not harder. These strategies could save you thousands in taxes. Ready to unlock your financial superpower? Let's dive in. Introduction. Investing is all about growing your wealth. But what's the point of earning big returns if taxes take a huge bite out of them? Today, I'll show you how to keep more of your hard-earned money with tax-efficient investing. Strategy 1. Tax loss harvesting. This strategy allows you to minimize taxes by offsetting gains with losses. Here's how it works. Suppose you invest in stock A, and unfortunately, it loses value. You sell it at a loss, which creates a tax deduction. You can then use this loss to offset gains from another investment, stock B, which performed well. The result? You pay taxes only on the net gain. Example: meet Sarah, an investor with a $5,000 gain from stock B, a stock she bought early in the year. Unfortunately, she also had a $2,000 loss from stock A, which didn't perform as expected. By using the tax loss harvesting strategy, Sarah sold stock A to realize the $2,000 loss. This loss was then used to offset her $5,000 gain from stock B, reducing her taxable gain to just $3,000. Since Sarah is in a 20% capital gains tax bracket, this saved her $600 in taxes she would have otherwise owed. By strategically managing her investments, Sarah effectively reduced her tax liability while staying on track with her financial goals. Bonus tip: if your losses exceed your gains, you can use up to $3,000 of that loss to reduce other taxable income and carry forward the remaining loss to future years. Strategy 2. Asset location. Not all accounts are created equal. Asset location means strategically placing your investments in accounts based on their tax treatment. Taxable accounts. These are better for investments with lower tax burdens like index funds or ETFs. They're efficient because they generate fewer taxable events. Tax-advantaged accounts. These include Roth IRAs, traditional IRAs, and 401ks. They're ideal for high-growth investments like stocks because the tax advantages shield your returns. Example: John, an investor who carefully planned his portfolio. He decided to invest in dividend-paying stocks within his Roth IRA. Why? Because in a Roth IRA, any dividends generated are completely tax-free. Over the years, this decision has allowed John's investments to compound uninterrupted by taxes. If he had held these same stocks in a taxable account, he would have paid taxes on every dividend received, significantly reducing his returns. Strategy 3. Use tax-advantaged accounts. Speaking of tax-advantaged accounts, let's explore their unique benefits. A Roth IRA. You pay taxes up front, but your money grows tax-free, and withdrawals in retirement are also tax-free. Perfect for young investors who expect to be in a higher tax bracket later. Traditional IRA 401k. Contributions are tax-deductible today, meaning you lower your taxable income now. However, withdrawals in retirement are taxed. HSA, Health Savings Account. The ultimate triple tax advantage. Contributions are pre-tax, growth is tax-free, and withdrawals for medical expenses are also tax-free. It's a powerful tool for healthcare and retirement. Example: let's talk about Emma. She contributes $6,000 annually to her Roth IRA starting at age 25. By the time she retires at 65, she's built a $500,000 tax-free nest egg. This means she has access to all that money without worrying about tax deductions. If she had chosen a traditional IRA instead, she'd still owe taxes on her withdrawals, reducing her spending power. Emma's choice of a Roth IRA was a game-changer for her financial future. Bonus tips for tax-efficient investing. Reinvest dividends smartly. Instead of taking dividends as cash, reinvest them within tax-advantage accounts to avoid triggering taxes. For example, Chris, a young investor, set his mutual fund dividends to automatically reinvest. By doing so, he avoided taxable events and allowed his investments to grow at a faster rate. Hold investments long-term. Capital gains taxes are significantly lower for investments held longer than a year. Think of it as a reward for patience. For example, Lisa bought shares of a tech company in 2020 and held onto them for 3 years. When she sold them, she qualified for the lower long-term capital gains tax rate of 15%, instead of the short-term rate of 22%. This saved her hundreds of dollars in taxes. Municipal bonds. These bonds offer interest income that's often tax-free at the federal level and sometimes at the state level too. Ideal for high-income earners. For example, Michael, a high-income earner, invested in municipal bonds issued by his state. These bonds provided him with steady income, completely exempt from both federal and state taxes. This made them a perfect low-risk addition to his portfolio. Regular portfolio reviews. Check your portfolio annually to ensure you're optimizing for tax efficiency and rebalancing if needed. For example, every December, Amanda reviews her portfolio with her financial advisor. Last year, she identified underperforming stocks to sell for tax loss harvesting, saving her $1,200 in taxes while maintaining her portfolio's target allocation. Call to action. Tax-efficient investing isn't just a strategy, it's your ticket to financial freedom. Start applying these tips today, because every dollar saved in taxes is a dollar closer to your dreams. Your financial success starts here. See you in the next video, where we'll help you build the wealthy life you deserve. If you find this video helpful, then please subscribe to my channel and like this video. That will encourage me in making such videos.